Hey, what is up, guys? Stock market reaches new all-time high mark one after another. This trend seems to be impossible to break. However, market is cyclical. What goes up eventually will have to come down. In this video, we will take a look at the greatest investor of all time, Warren Buffett, who potentially is predicting an upcoming stock market crash. Warren Buffett, without a doubt, the most successful investor in this generation. He is a founder and the CEO of Berkshire Hathaway. Berkshire Hathaway is a multinational conglomerate holding company that is run and managed by Warren Buffett himself. Until this date, he is still the main financial analyst and a stock picker at the age of 89. Since 1965, Warren Buffett built unbelievable rate of returns. His average compound rate of returns is approximately 20%, comparing to an average 10% rate of returns of S&P 500. He beats the stock market 80% of the time, year after year. If you cannot comprehend what I just said, let me simplify a bit. If you would invest $1,000 in Berkshire Hathaway in 1980s, when one share was around $250 of Berkshire Hathaway A-class, now you would have over $1.35 million. However, if you would invest $1,000 in benchmark S&P 500 in 1980s, when one share was at $120, now you would have over $25,000. There seems to be a huge difference, right? Yes. The power of compounding is the eighth wonder of the world. It is very powerful, especially if you take it seriously. Well, this is not the reason why I'm making this video. I guess in the end we all agree that Warren Buffett is a phenomenal investor. When he talks, everyone should listen. And he spoke in his first interview ever in 1962, talking about a stock market crash. Let's take a quick look what exactly he had to say about the stock market back then, and I will explain why it matters today.
I think the president's action on steel probably had something to do with the timing of the decline, but I don't think it was the factor which determined the amount of the decline. For some time, stocks have been rising at rather rapid rates. Corporate earnings have not been rising, dividends have not been increasing, and it's not to be unexpected that perhaps a correction of some of those unusual factors on the upside might occur on the downside.
Well, some observers from time to time say that the stock market is a forecaster of events to come. Can you predict, or would you care to take a look at what you think this might be forecasting, the decline?
The stock market has been a good forecaster from time to time in the past. It also has been a rather poor forecaster occasionally. For example, the last 4 or 5 years, the stock market has been booming along and presumably forecasting better business, which has really not materialized. Corporate profits are not any better than they were 5 years ago, but stock prices are 50% higher or thereabouts. So maybe the stock market is really correcting a previous incorrect forecast this time rather than making a new correct one.
In that interview, he stated that, for some times, the stock market was rising in very rapid rate, while corporate earnings have not been rising and dividends have not been increasing as well, which means some correction in the market is reasonably expected. But why does it matter today? Let's take a look at S&P 500 index. Since the last housing bubble, which happened in 2008, we have seen enormous growth in the stock market. At the top of 2007, before the stock market crashed, one share of S&P 500 was trading around $1,500. Now it's more than $3,200. That's more than 100% increase. But let's take a look what happened in earnings. If you look at this chart, at the top of the peak in 2007, earnings were around $85 a share. But now, current earnings are close to $130 a share. That's only 50% increase since 2007, while the stock market rose by 100% during the same time frame. That's a huge difference. We already know that Warren Buffett does not really get involved into macroeconomics. His main investment philosophy is to invest in great businesses, the ones that have great economic moat, competitive advantage, understandable, and the most importantly, the ones that trade at the reasonable market price. Yeah, tell us something else we do not know. Well, here is what I have to say. We should pay attention to what Warren Buffett does and not necessarily what he says publicly. His cash position speaks for itself. His cash is currently a great indicator when stock market is cheap and when it's expensive. Let's take a quick look at 2018 Berkshire Hathaway annual meeting when a shareholder put Warren Buffett on the spot and asked why he does not put the cash into use.
Warren, you are a big advocate of index investing and of not trying to time the market. But by your having Berkshire hold such a large amount of cash and T-bills, it seems to me you don't practice what you preach. I'm thinking that a good alternative would be for you to invest most of Berkshire's excess cash in a well-diversified index fund until you find an attractive acquisition or buy back stock. Had you done that over the past 15 years, all the time keeping the $20 billion cash cushion you want, I estimate that at the end of 2018, the company's $112 billion balance in cash equivalents, and short-term investments in T-bills would have instead been worth about $155 billion. The difference between the two figures is an opportunity cost equal to more than 12% of Berkshire's current book value. What is your response to what I say? And I forgot to say the question is from Mike Elzhar, who is with the Colony Group located in Boca Raton, Florida.
That's a perfectly decent question, and I wouldn't quarrel with the numbers. And I would say that is an alternative, for example, that my successor may wish to employ, because on balance, I would rather own an index fund than carry treasury bills. I would say that if we'd instituted that policy in 2007 or 8, we might have been in a different position in terms of our ability to move late in 2008 or 2009. So it has certain execution problems with hundreds of billions of dollars than it does if you were having a similar policy with $1 billion or $2 billion or something of the sort. But it's a perfectly rational observation, and certainly looking back on 10 years of a bull market, it really jumps out at you. But I would argue that if you were working with smaller numbers, it would make a lot of sense. And if we're working with large numbers, it might well make sense in the future at Berkshire to operate that way. You know, we committed $10 billion a week ago, and there are conditions under which, and they're not remote, they're not likely in any given week or month or year, but there are conditions under which we could spend $100 billion very, very quickly. And if we did, if those conditions existed, it would be the capital very well deployed and much better than in an index fund. And so we're operating on the basis that we will get chances to deploy capital. They will come in clumps in all likelihood, and they will come when other people don't want to allocate capital. Charlie, what do you think about it?
Well, I plead guilty to being a little more conservative with the cash than other people, but I think that's all right. We could have put all the money into a lot of securities that would have done better than the S&P with 20/20 hindsight. Remember, we had all that extra cash all that period if something had come along in the way of opportunities and so on. I don't think it's a sin to be a little strong on cash when you're as big a company as we are. We don't have to. I watched Harvard use the last ounce of their cash, including all their prepaid tuition from the parents, and plunge it into the market at exactly the wrong moment and make a lot of forward commitments to private equity. And they suffered like 2 or 3 years of absolute agony. We don't want to be like Harvard.
Plus timber and a whole bunch of things.
What?
I mean, plus timber and I mean.
Yeah. We're not going to change.
No. We do like having a lot of money to be able to operate very fast and very big, and we don't. And maybe we won't. We know we won't get those opportunities frequently. I don't think. Certainly, in the next 20 or 30 years, there'll be 2 or 3 times when it'll be raining gold, and all you have to do is go outside. But we don't know when they will happen, and we have a lot of money to commit. And I would say that if you told me I had to either carry short-term treasury bills or have index funds and just let that money be invested in American generally, I would take the index funds. But we still have hopes. And the one thing you should very definitely understand about Berkshire is that we run the business in a way that we think is consistent with serving shareholders who have virtually all of their net worth in Berkshire. I happen to be in that position myself, but I would do it that way under any circumstances. We have a lot of people who trust us, who really have disproportionate amounts of Berkshire compared to their net worth if you were to follow standard investment procedures. And we want to make money for everybody, but we want to make very, very sure that we don't lose permanently money for anybody that buys our stock somewhere around intrinsic business value to begin with. We have an aversion to having 1 million plus shareholders, maybe as many as 2 million, and having a lot of them ever really lose money if they're willing to stay with us for a while. And we know how people behave when the world generally is upset, and they want to be with something. I think they want to be with something that they feel is like the Rock of Gibraltar, and we have a real disposition toward that group.
The current market cap of Berkshire Hathaway is close to $550 billion. The total cash and cash equivalent is over $128 billion. Actually, 1/4 of the entire market cap in pure cash. Does this mean that Warren Buffett does not know what to do with all that money? Well, pretty much. He cannot find great businesses and reasonable prices, which means stock market is quite expensive. Yes, he could easily invest all that remaining cash into S&P 500. But no, the position is way too large. It is better to stay liquid and wait until it will rain gold outside. And then you can pick up 50 cents on a dollar. If you look at this chart, his cash position skyrocketed since 2008. In 2000 and in 2008, his cash position was very small, meaning he could easily find great companies at great prices and put the capital to use. In 2007, before the market crash, his cash position piled up, and since then it tripled, even though Warren Buffett perfectly understands that cash itself is lousy investment. Considering the inflation rate, we probably lose 3 to 4% of our purchasing power every year. But he bets on the market correction. When the time will come, his cash will be utilized to outperform all the inflation that was eating his cash year after year. Not just Warren Buffett is betting on a stock market decline. Another reputable entrepreneur and an investor featured in Forbes 30 Under 30 magazine, Christopher Oberder, also believes that bullish cycle to end soon, and he stated, "The market has to correct eventually. It seems like we are getting really close. The quantitative easing program from the central banks have delayed a crash, and the outcome of the next American president election in 2020 will be indicative in what direction the economy is heading. But it won't change the historical trend of the economic cycle. My prediction is that in 2021 we will see a major correction." I would have to agree with Chris that the correction is not a question of if, it's a question of when. It is very likely that it will come somewhere in between 2020 and 2021. I would definitely recommend to follow Chris on Instagram at startup_Chris. Now let's take a look at PE ratio of S&P 500 to determine if stocks are indeed expensive or cheap. Current PE ratio is almost 24. In 2000 dot-com bubble, PE ratio was over 35. In 2007 housing bubble, PE ratio skyrocketed all the way over 60. However, those were very unique cases that we have never seen before. In 1929 and Great Depression, PE ratio was only at 23, similar to today. I think the good rule of thumb is if PE ratio is below 15, it's a great indication that stock market is cheap, and if it's above 20, it means that stocks are expensive. Let me know what do you guys think about all Warren Buffett's cash and his potential prediction about stock market correction. Leave your thoughts in the comment section below, hit that like button and subscribe.